Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SSY Group Limited Annual Report. SSY Group Limited offers a diverse range of businesses and services across various industries. At the core of their operations are pharmaceutical products, which include intravenous infusion solutions, ampule injections, small volume injections, oral preparations, Chinese medicine preparations, biological preparations, bulk pharmaceutical products, and medical materials. In addition to pharmaceuticals, the company is involved in research and development of pharmaceutical technology, consulting services for pharmaceutical companies, and logistics services for pharmaceutical products. They also operate food, beverages, and catering businesses, further expanding their reach into the consumer market. Furthermore, SSY Group Limited engages in the production and sale of methylamine, a chemical compound used in various industrial applications. Their product portfolio is complemented by the Scheiman brand name, which is recognized globally for its quality and reliability. With operations spanning across China and internationally, SSY Group Limited has established itself as a prominent player in multiple industries. SSY Group Limited maintains a market capitalization of $7 billion, broadly in line with the industry peer group. SSY Group Limited trades at a higher price-to-earnings ratio of 16 times and a lower price-to-book ratio of 1 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.4%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors affecting a company's revenue. On one hand, revenue growth is primarily driven by the increasing demand for certain therapeutic infusion solution products, such as levofloxacin and sodium chloride injection. Additionally, the expansion into new markets through the export of preparations, including infusion solutions and oral preparations, has also contributed to revenue growth. Furthermore, the company's ability to diversify its product offerings with bulk pharmaceuticals, such as metronidazole and hydroxyethyl starch, has also led to an increase in revenue. On the other hand, revenue decline is primarily driven by a decrease in demand for certain products, including intravenous infusion solutions and ampule injections. The drop in average selling prices of existing IV solution and ampule injections products has also contributed to the decline in revenue. The reduction in overall sales volume of IV solution from last year has further exacerbated the decline in revenue. It is clear that the company's revenue growth or decline is heavily influenced by market demand, product offerings, and pricing strategies. By understanding these drivers, the company can make informed decisions to mitigate revenue decline and capitalize on opportunities for growth. The net income of the company experienced a significant decline, decreasing by 55.6%. This substantial drop in net income is also reflected in the profit margins, which saw a notable decrease across various categories. Gross profit margin and operating profit margin both witnessed a decline of 8.3 and 8.1 percentage points respectively. The net profit margin, which measures profitability after accounting for taxes and interest, dropped from 18.4% to 11.3%. These changes in profit margins indicate that the company's ability to maintain its pricing power and control costs has been compromised. The reasons behind these changes are not explicitly stated, but it can be inferred that a combination of factors such as increased competition, rising costs, or decreased sales may have contributed to this decline. The company's financial performance suggests a positive trend in its operating cash flow. Multiple sources indicate that the company generates a significant amount of net cash from operating activities, which is used to finance its working capital and other capital requirements. However, there are also instances where additional information is needed to confirm this, highlighting some uncertainty surrounding the company's operating cash flow. Despite these limitations, it appears likely that the company is generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the company's borrowings increased by a substantial 170.3% from $1,112,153, indicating a notable rise in its debt level. This increase is further reflected in the bank borrowings, which rose from HK $3,635,931,000 to HK $4,010,800,000. However, despite the significant increase in debt, the interest expenses have actually decreased. The interest expense of borrowings dropped from $126,679 in 2024 to $105,524 in 2025, indicating a reduction in the company's interest burden. This decrease is attributed to lower average bank borrowings interest rates, which suggests that the company has been able to secure more favorable loan terms. Overall, while the debt level has increased significantly, the interest expenses have decreased, suggesting some cost savings for the company. The company's performance can be analyzed through its various segments and regions. On a positive note, the intravenous infusion solution segment and medical materials segment showed similar revenue growth and operating profit compared to the previous year. These segments have been stable and consistent in their performance. However, there are also areas of concern. The unallocated segment incurred a significant loss of $53,231, indicating a need for improvement. Additionally, the overtime revenue recognition region had very low revenue of just $497 from external customers, suggesting a lack of growth or activity in this area. These underperforming segments and regions will require attention to rectify their issues and improve overall performance. Management is optimistic about the company's future prospects. They plan to accelerate construction progress on ongoing and new projects, which will likely boost revenue and growth. Additionally, they aim to enhance their supply chain, create new growth poles, and reinforce their market position, further solidifying their competitive edge. In a strategic move, management intends to leverage the company's strengths to pursue mergers and acquisitions and investments in the pharmaceutical industry. This bold approach is expected to drive innovation and expansion, ultimately leading to increased returns for investors. By implementing business tasks for 2026, management is committed to delivering satisfactory results and meeting investor expectations. Overall, these plans demonstrate a clear vision for growth and success, positioning the company for long-term prosperity. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be reported under this category. This suggests a stable and consistent approach to business operations, with no major changes in the company's portfolio over the period in question. The company's dividend payments have been consistent over the past 2 years. In 2024, it paid out a total of HK $517,844 in dividends. For 2025, although the proposed dividend is lower at HK $6,977, it has already paid out HK $133,703. In terms of share buybacks, the company has been actively repurchasing and canceling its own shares. In 2024, it canceled a significant number of shares totaling 11,084,000. This trend continued in 2025, with another large-scale cancellation of 6,846,000 shares. That concludes the financial summary for SSY Group Limited. Feel free to comment below, and I will be happy to answer them when possible.